Hello, this is Huro from Audit Markets. We'll be with you with short review on June NFP numbers and market reaction. As always, first we will check the data and see what the market gives us as a data, and then we will see the reactions. The second calendar, as you see here, okay. Average earnings increased by 0.3% in June as a monthly base and in annual scale. Income increased by 3.9%. The average income earnings or income increased by 3.9%. Both of them, they are in line with the expectations. They don't have anything as a surprise. At the same time, these numbers can say that the incomes is in the same way that the Federal Reserve wants, and they can somehow control the inflation with the lower income. So when there is a less income, the people they spend less. The demand is descending. We will have a less demand, so less demand means less inflation as well. So the income, they are in a way that the Federal Reserve want, and they will encourage the Federal Reserve to cut the rates by 0.25% in September. Next data says that the number of the jobs that have been created in June is 206K. So they are a little bit more than 190K that the market was expecting, but still lower than 280K that were created in May. So which means that labor market is getting weaker and slower. That increased the unemployment rate from 4% to 4.1% in June, which means that at the same time that 136K job have been created in private sections. So these that the other number that we have to look carefully is this one, the participation. The participation is 62.6%. It's a little bit more than 62.5%, which means that the people, they are getting more interested in finding the job. The people, they are getting more interested, or they feel more need to have the job, and they're looking at the job, and they're active in the job market. So this data generally means that the market has more, the labor market is a little bit weaker than expected. So if you check the dot plots of the Federal Reserve, the dot plots that we had like 2 or 3 months, the previous month, not the data that we had previous month, the one before that. Federal Reserve was expecting the unemployment rate at 4% for 2024 and 4.1% for 2021. And then in a previous meeting, they changed this 4% to 4.1% as estimates and expectation of unemployment rate in 2024, which is right now, you can see here 4.1%. That's the same expectation of the Federal Reserve's dot plot that we had in the previous meeting. So these numbers generally means that the Federal Reserve will have more, will be more encouraged to cut the rates by September. And if you refresh the page, we see what the CME Group expectation is 95, more than 95% to hold the rates at the current level for this month. But in September, now the market expecting 71%. This much higher than previous 61, 67, or 64% market estimate. So now market expecting more than 71% to cut the rates by Federal Reserve at the 25 BPS or 25 basis point in September meeting. That means that can pressure the US dollar and encourage. Let me share my page, my chart. You can see here. This data means that, as you see here, the US dollar can get more pressure and get a little bit weaker with less demand as the market expecting the Federal Reserve to cut the rate. So that's will be a negative news for the US dollar index. So we can probably see the US dollar less than under 105 marks for the next week, next days. That means that the stock markets can get a little bit encouraged and can have more benefits from that. But at the same time, since this data and the previous data we had this week shows that the economy is getting weaker in the United States, which that means sorry, the economy is getting weaker in the United States, which means the stock markets also even thought that the market's expecting to cut the rates in September, but still stock markets will not be so happy with this news, so will not increase the much. We say that, okay, the Federal Reserve is getting more dovish policy, so it can help the stock markets. No, that cannot help right now because the market already was expecting 25 basis point rate cut for September. That was something that market has been pricing. The markets have been pricing so for the several months. So it's not something surprise. So these numbers, these data, and these expectations cannot support the US dollar index. It cannot support the stock market, but they can pressure US dollar index against US dollar against this process, which means that US dollar index can get a little bit more pressure, but not much. Generally, that's the market reaction. The same thing we can see in Nasdaq. You see the Nasdaq also already started to losing the gains. Same thing we can see for S&P for Dow Jones. The Dow Jones a little bit gained right now, the Dow Jones, but generally the Dow Jones also saying they'll follow the same path of the S&P 500 and Nasdaq. So we cannot expect the stock market to gain more than this right now at the moment with this data that they confirm the weaker economic condition. That's the general data and market reaction. If you had any question, please don't forget to write down in the comment section under this video. I will try to get back to you as soon as possible. Talk to you soon. Bye.